it's actually infuriating.
Yeah.
Right. But why are they doing this? Okay. Honestly, they're doing it to protect the dollar. Right. So because of what we just talked about, they need that inflation to stay down enough that it doesn't look like it's it's hyperinflating.
Yeah. At least the perception of inflation, right?
The perception.
Yeah.
But they need it to be high enough to inflate away the old debt. And that's where we're at right now. So that's kind of the game that they're playing. And they all know it.
Yeah.
This is not any, you and I read these things on Twitter, the Fed and the Treasury, they're idiots. They're not idiots. They know what's going on.
Right.
It's just, they have to assume we're all idiots.
It's like a controlled demolition or something.
Yeah. It's like it's kind of like, we know we have this incurable disease, this incurable debt disease.
Yeah.
And we're going to draw it out for as long as we can.
Right.
Hey everybody, welcome to the What is Money Show. I am thrilled to have you here joining me on my mission to help shine light on the corruption of money. Now, if this is your first time listening to the What is Money Show, I strongly recommend that you go back to episodes 1 through 9 first, which lays a lot of the groundwork for many of the concepts that we explore on the show. These first 9 episodes are my series with Michael Saylor, and thousands of people have told me that this is the best podcast series they've ever heard, hands down, and that it was instrumental to their understanding of money and Bitcoin. So if you're looking to start a deep dive into the nature of money, I don't think there's any place better that you can start other than episode 1 of this show. Now, a little bit about this show and how it makes money. The What is Money Show is 100% sponsor based. So all of our revenues are derived from direct sponsorships. And I strive to be very selective about the sponsors that I work with, specifically only using sponsors that I use personally, and also choosing sponsors that have values which are well aligned to the values expressed on this show, such as freedom, education, self-sovereignty, etc. So what I'm going to do now is a few ad reads right at the top of the show, and then I'll do a few more ad reads in the middle. And I hope you'll take the time to listen to them, as again, these are hand-selected sponsors, and I think you'll like what they have to offer. Today's podcast is brought to you by In Wolf's Clothing. Wolf is the world's first startup accelerator program focused exclusively on the Bitcoin Lightning Network. 4 times per year, Wolf brings teams from around the world to New York City to work with like-minded entrepreneurs, pushing the boundaries of what is possible with Bitcoin and Lightning. The program is designed to help early-stage companies achieve product-market fit, develop their brand, secure early-stage funding, and grow businesses that help fuel the global adoption of Bitcoin. So go to wolfnyc.com today to apply for the program or learn more. Again, that is wolfnyc.com.
James Lavish, welcome to the What is Money Show.
I'm happy to be here, Robert. It's been a long time coming to sit down with you.
Yeah, man, it's great to have you here. This is an extra special edition because we're here in Jackson Hole for the Bitcoin Ski Summit.
Man,
in a gigantic, luxurious cabin, sitting next to a fire, having a real live fireside chat.
If this is a cabin, I don't know what I live in.
Yeah, I don't know what you call this, like a chalet?
A chalet.
Yeah, that's pretty damn nice.
Nice.
Quick introduction for you. You are the managing partner of the Bitcoin Opportunity Fund, and you are the author of the very popular The Informationist newsletter, which I think is just on Substack, right?
It's on Substack.
Gotcha.
Yeah.
Let's start with that. Like, just a quick intro about you, who you are, your professional background, and your path into Bitcoin.
Yeah. So some of your listeners may know this, but I've been an institutional investor for many years, more than I want to admit, but nearing 30. And so I started down on the floor of the New York Stock Exchange, trading something called ADR arbitrage, where you're buying and selling foreign securities on the New York Stock Exchange. And so you translate those with a basket and currency and stamp tax, and there's an arbitrage there. Huh. That was, Robert, that's before we had spreadsheets.
Ooh,
so it was great because it was all by hand. Whoever could do it fastest got the trade. So that's where we started. So I was there in New York for a number of years, and then I ended up because I was doing arbitrage, I ended up getting picked up by a hedge fund within Travelers Group, and then just stayed in hedge funds and private equity ever since. And so I've been doing that a long time. But yeah, how did I get to Bitcoin? Well, as an institutional investor, back in 2018, I had a little bit of extra like risk capital, personal capital, discretionary that I want to put to work, and I want to go out on the risk curve a little bit. I want to move out and to do something a little bit on the fringe. And so I kept hearing about this Bitcoin thing, and you know, when you're in that world, you pretty much ignore it because it's you have to go to a parking lot with a suitcase of money and because once Mt. Gox once that blew up, there was just a lot of negativity around it, drug money, whatever. So, but 2018, it started getting some real traction. It had already run to 20,000. It came all the way back in about $3,500. I thought, there's definitely something here. There's something here. So I went, and what you do when you're an institutional investor, you go talk to the so-called experts. Then, these are the technology analysts and portfolio managers from Wall Street, whether it's Citigroup or JP Morgan or in my own firm. Every single person I talked to, every single one of them, bar none, warned me off, told me there's no inherent value. It's going to zero because it's a Ponzi scheme. Avoid it at all costs.
All Wall Street guys saying this?
All Wall Street guys. Yeah. So I missed it. I missed it in 2018. Circle back to 2020. We're in lockdown. I'm leaving my firm and my son, and he knows that I'm looking to do something, not sure what to do. And so he said, "Hey, Dad, I think you ought to give this digital asset world another look. And I think you ought to dig in there because there's definitely investment opportunity." And so he's a smart kid, and I thought, yeah, I think I really do need to start learning these protocols. And so I did what a normal institutional investor turned digital investor would do, and I went and bought Ethereum and Solana and Cardano, and it took me about, I think I want to say it took me about 4 or 5 weeks, Robert, of listening to podcasts, listening to yours, watching Michael Saylor, listening to Jeff Booth, and then it clicked, and I realized I've got to get all my money out of these other untrustworthy protocols and into Bitcoin. And so I went all in on Bitcoin for that allocation, and I've been here ever since. And so, yeah.
That's awesome. Well, good thing you learned fast, man. It takes a lot of us a lot longer and a lot more pain to get out of the shit coins and into Bitcoin.
Oh, well, yeah. Well, it wasn't exactly an awesome time to own them, right? So it wasn't. I wasn't making 100x returns on them. So it was pretty easy. I was just focused on the underlying value and whether I could trust the protocols. That's a big thing for me, just being able to trust it. Yeah. And I never could. I just never felt like I could trust anything else.
Yeah.
So
it's a good instinct because I think the deep revelation is only Bitcoin is decentralized. Right, all this talk about decentralized protocols, decentralized finance, etc. It's bullshit, right?
It's bullshit.
We're seeing it right now. And I haven't looked into this, but I've just seen the Twitter headlines. The bankless guys that pump all these DeFi shitcoin everything. Mm-hmm. They've received a Wells notice, I think, from the SEC. So it's kind of ironic that the decentralized finance guys are now getting shut down by a centralized regulator.
We need some regulation in this area. There's no doubt about it. But, yeah. I mean, and then when you're an investor and you look for assets to protect your capital in. Uh-huh. And so, and Bitcoin was like, I just kept hearing digital gold, 21 million, only 21 million will ever be made. And then once I read the white paper and understood, okay, I understand now how this works and how that actually is limited by the decentralized nature, the truly decentralized nature of the protocol, then I got comfort pretty quickly. What I didn't know though, Robert, was where was it going? Like, why did it matter? Mm-hmm. Was it just going to be digital gold? Was it really going to be adopted, and what could be done with it? And so that getting me over that goal line was a good friend of ours now. I didn't know him at the time. Was Jeff Booth. He was having a conversation with somebody and on a podcast, and I was watching this, and I was supposed to be helping my wife make dinner, right? So I was supposed to be in the kitchen. She's like, "What are you doing?" And I'm in the office, and I've got my laptop, and I'm about 20 minutes or 25 minutes into this podcast, and I'm listening to Jeff talk about the inflationary pressures coming from the Fed and from central banks versus the deflationary nature of advancement in technology, and how they'll eventually clash.
Yeah.
And so, that moment, it was like, I get it. Okay. Now I see it. That just brought it all together for me. So I brought my wife in. I was like, "You've got to see this." We sat on the edge of the bed and watched the entire interview, an hour of it, while, whatever was burning on the stove. And at the end of it, she looked up at me and she goes, "Do we own enough?"
That's awesome.
Bitcoin's the answer.
Do you know which episode that was with Jeff?
I can't remember. It was, I can't remember. Truly, I can't remember.
His thesis there is truly mind blowing, right? It's not possible to try to keep increasing human productivity under a central banking paradigm, because they're literally going in opposite directions. So the thing rips itself apart.
Exactly. And we're seeing it in Japan right now.
Yeah.
They need inflation. Why do they need inflation? Because they have 250% debt to GDP. Now, it's different than the United States. We've been over this. You've talked to Lynn about it, I think, before. They're a net exporter. They have a different demographic. So there's different dynamics at play versus the United States. But how are they going to overcome all that debt?
Right.
Inflation. They need inflation.
Yeah.
So they need to inflate their GDP. And so they're trying to drive inflation through keeping their interest rates super low, artificially low.
Right.
So
that's a good way to look at inflation, I think, is this form of implicit default, basically, right?
That's right. It's just like a daily default.
Yeah.
Every single day.
Yeah.
Your dollar's worth less than it was the day before. Period.
Right. And that's the taxpayer picking up the bill for government negligence.
So think about it. You've got, we know we operate in a deficit. We've talked about this before. We operate in a deficit and perpetually, and there's no way to get out of that deficit. Why? Well, if you look at numbers and where we are today, the Congressional Budget Office puts out data periodically. They had a report last May. They just came out with a report a few weeks ago, and it updates where they see the Treasury and the balance sheet and the income statement. Well, we both know, like you just said, the Treasury doesn't really make any income. Right. They collect ours through taxes. It's tax revenue. That's it. But in this report, which is super rosy, it is optimistic, and it's even a little bit old. Well, they project the Treasury to they're going to take in about $4.8 trillion in taxes this year, tax revenue, tax collection, and but you have three main items in that make up the things that you have to spend money on, the expenses of the United States government, right? Three main items, and then you've got your revenue. All right, you got $4.8 trillion of revenue. Well, your entitlements are $3.8 trillion. Okay, so that's Social Security, Medicaid, Medicare, and some other programs adds up to $3.8 trillion a year. Okay, you have your defense spending. Well, but first, those entitlements, those are signed into legislation. They have to be paid, right? That's mandatory expense.
Right.
Then you've got your long-term defense contracts, and those have to be paid. You can't default on payments with Boeing or Lockheed. You have to be paying those.
Right.
So, and that's they are estimating $700 billion this year in 2023, which we know is probably pretty low, especially since they're stuffing expenses for Ukraine and other places probably.
Right.
We just don't know exactly what those are.
Right.
So then you're now at 4.5 trillion, right? So you've got $300 billion left for your interest expense. However, they're expecting interest expense to be at $800 billion, right? And I think I actually transpose those numbers. Defense, they're expecting to be 700, to be 800, and interest is going to be 700. But the point is, you're now at $5.3 trillion of expenses
Right.
on $4.8 trillion of revenue. So we're $500 billion in the hole. Well, what do? You have three choices. You can have austerity, which is cutting back programs, cutting back spending.
Yeah.
It's political suicide.
Yeah.
Neither party wants to do that, but they want to try to push the other party to do it.
Sure.
Right? Which we're seeing right now,
Yeah.
the whole debt crisis, the debt ceiling crisis. So you can do that. You can raise taxes. And taxes are pretty high already. And when you do raise taxes, eventually it just slows productivity and it winds up having the same effect. It doesn't help.
Yeah.
Or the third thing you could do is just issue more debt. Simple as that. Just issue more debt. So what we do is, as this debt matures, we issue more debt to pay off the principal
Yes.
of the people who own that debt, right? So, but the problem is we're operating in this perpetual deficit. So when you issue more debt and you're paying off that old debt, then that old debt was issued at very low interest rates, anywhere from just a few basis points up to maybe 1.5%, 1.75%, right? So this old debt that we're retiring, that matures, is now being replaced with debt that's about anywhere from 3.5% to 5% yield. So you see the problem, right? So mathematically, we have hundreds of billions of dollars more in expenses every year for new interest that we weren't paying last year. So the interest payments are going higher. More debt at higher interest rates equals, this is what we call the debt spiral,
Right.
because you can't get out of it. You have to keep issuing more debt at higher interest rates, which just, this is the debt spiral. That's it. And we will never get out of this.
And to be clear, the $500 billion that we're printing to cover that interest expense, or borrowing rather, is being printed by the Federal Reserve, right?
Well, not today. What happens is we sell that debt to private holders, banks or other sovereigns, and so we have this luxury in the United States of being the global reserve asset, right? The Treasury. And so everybody needs dollars, everybody needs treasuries to protect themselves, because it's known as the reserve asset, right? So we can keep issuing debt. So here's where we're at. We can keep doing that until there's a collapse in confidence in the US dollar. Right. So, which is what you and I were talking about just before the show, is that when does it all happen? When does it all collapse? Well, this can go on for a very long time. The US dollar is going to be the last one standing. It will swallow other currencies along the way, in Brent Johnson's milkshake theory from Santiago Capital. Right. But what will happen is eventually the confidence in the dollar wavers. Why? Well, we have so much debt and our inflation is so high that people realize that if they own this treasury, that in 10 years, it's only going to be worth a fraction of what they bought it for, even with the interest rate. Why? Because real rates of return are negative.
Yeah.
Because if your inflation is higher than the interest rate on that bond, then it's a negative real yield.
Yeah.
So you're getting back dollars that are worth less, right? Then you can buy fewer or less of the goods and services that you could otherwise.
Right.
The day that you bought those bonds. And so that's where we're at. The Fed is trying to make sure that we keep our interest rate, our CPI, the inflation rate down, at least in perception. They want people to perceive that inflation is under control. It's in check, because they can't have the buyers of our bonds lose confidence in the currency, and you lose confidence in the currency when it inflates too much because of what I just talked about, right? So they play with the numbers, they adjust the CPI, they adjust the way that they put things in and take and replace things in and out of the basket, They back in the 80s and before that, they used this. They used it was just a basket of goods, right? And it's just they used the same basket, and every single year they just priced that basket, and so you could see exactly what the inflation rate was. But they changed that to like an equivalent living index, right? So now what they can do is they can take goods in and out of the basket, depending on how much they're inflating or how much people are using them. Right. Well, there's elasticity, right? So if steaks are inflating, if they're getting too expensive, well, you might turn to ground beef instead, which is not inflating nearly as much. Well, so what the Bureau of Labor Services will do is they'll say, well, people are turning to ground beef in our surveys, so we're going to take steak out and put ground beef in. Well, what does that do? I mean, it's like survivorship. It's skewed to the survivorship of the goods, right? So, well, that one's too expensive, so take it out. Now your inflation rate comes down a little bit because of it. I mean, they do this. They play all kinds of games. The timing of when they track the goods goes from they just change it from 2 years to 1 year, so they can take things in and out of the basket every year now instead of every two. It's just
this is like earnings management on Wall Street, right? You're just tweaking the accounting classification so you can get to the number you want, so you can hit your EPS bonus target. Exactly. It's in the hypocrisy of it, right? It's if the CPI, which is intended to be a metric for price changes that are most relevant to most people, the things that actually change in price, they strip out. Yeah, I mean, this is totally
it's nonsense.
Yeah.
Now I'd like to tell you about our sponsor, iCoin Technology. iCoin has just released a sleek new hardware wallet. It looks like a mini iPhone, a little touch screen and camera on it. The device has no Wi-Fi, no cellular connection, no GPS. It's a strictly physically cold hardware wallet. Like I said, it's got a high-res 3-inch touchscreen. It's got a camera for air gapping the wallet. It's got optional Bluetooth compatibility. And it's really a brand new UI, UX experience for a hardware wallet, making it very accessible, easy to use, not intimidating. And as we always talk about on this show, the only way you can truly own your Bitcoin is by having it in self-custody. So you need a device like iCoin Wallet to truly own your Bitcoin. Go to iCoinTechnology.com today and use promo code Bitcoin23 for 30% off of this new sleek hardware wallet. Now I'd like to tell you about our sponsor, Ledn. Ledn lets you do more with your digital assets. For instance, Ledn offers a B2X loan product that lets you leverage your existing Bitcoin to buy even more Bitcoin. Or you can also get traditional Bitcoin collateralized US dollar loans through Ledn as well. Ledn also offers both Bitcoin and USDC denominated savings accounts, letting you generate yield on your digital assets. Recently, Ledn has launched a Bitcoin mortgage product as well that lets you use Bitcoin to buy a home or finance one that you already own. So go to ledn.io, that's LEDN.io today to sign up.
It's actually infuriating.
Yeah.
Right? But why are they doing this? Okay. Honestly, they're doing it to protect the dollar, right? So because of what we just talked about, they need that inflation to stay down enough that it doesn't look like it's it's hyperinflating.
Yeah, at least the perception of inflation, right?
The perception.
Yeah.
But they need it to be high enough to inflate away the old debt. And that's where we're at right now. So that's kind of the game that they're playing. And they all know it.
Yeah.
This is not any, you and I read these things on Twitter, the Fed and the Treasury, they're idiots. They're not idiots. They know what's going on.
Right.
It's just, they have to assume we're all idiots.
It's like a controlled demolition or something.
Yeah. It's like it's kind of like we know we have this incurable disease, this incurable debt disease.
Yeah.
And we're going to draw it out for as long as we can.
Right.
And that's it. And hope that we can go on like this for decades, which we probably can.
Yeah, I'm really fascinated in that because it's like the broken incentives lead us into this self-deception at scale, right? That we just,
that's right.
We'll tweak the metrics, we'll do whatever we can. I'm reminded of this kind of joke. This is totally unrelated, but guys talking about when a guy goes out at night and he's like trying to meet a girl he's pushing away things all night. He's like, yeah, leave my car there. Oh, hold my keys. Yeah, we'll take a cab. Like, and then finally when the guy gets with the girl and gets off, like he comes to his senses and reality comes crashing back. It's like we're doing something like that. We're just trying to pretend that debt is not real, or we can just print money ad infinitum.
Yeah.
But the more you push reality back, like the harder it's going to snap.
And that's it. And so that's the point, is that we're starting to see cracks in the system from all this massive debt load, right?
Yeah.
So you're seeing it in Japan. They're printing and buying all their treasuries, right? They own over half their treasuries. It's just insane. The Bank of Japan, right? So, and then we saw it happen in the UK this past fall. All right. So Robert, so pension funds, right? A pension fund manages the pensions of the pensioners. Like, so if an employee joins that pension fund, well, then the pension fund knows that it looks at its tables and predicts how much they need to pay that person in the future when they retire, their retirement income, right? So, and they know that they've got to manage the money to get to that target, right? Well, how do you get to that target when you're supposed to own bonds to keep the volatility of your portfolio down? Because it's a pension fund. You know you need this money eventually.
Yeah.
You can't just hold growth stocks, right? So you've got to keep the volatility down. Well, how do you do that? You own bonds. Well, why would you own bonds when in Germany, just 18 months ago, there were $15 trillion of negative yielding bonds. And that's not real yield. That's negative nominal yield.
Wow.
So you're starving for yield in Europe over the last number of years. Why? Because of zero interest rate policy, ZIRP, right? Yeah. So what do? Well, the UK pensioners, the UK pension funds, they just decide to turn to something called an LDI. It's a leveraged debt instrument, right? So let's back up a few things. Number one, it's a derivative. Derivatives aren't inherently bad. They can actually help you negate a lot of risk in your portfolio or in a position. For instance, I used derivatives for years, billions and billions of dollars of derivatives.
So just to define, this is a contract on an underlying asset, right?
All it is a contract between two parties with an intermediary.
Okay.
And they're overseen. They're overseen by a group or a body called ISDA, International Settlement of Derivatives. So, but what happens is we just have this legal contract, right? And say I wanted to hedge out currency risk. So I own a bond that's denominated in euros, but I don't want the euro risk. Well, I could take out a derivative. I could do a swap, and I could swap out the euros for dollars. And so you would have the euro risk, and I would have the dollar risk, because maybe you have something in your portfolio that has a dollar risk that you don't want.
Right.
So we trade that.
Yeah.
And so that's what we do. Like that's a derivative. Okay. So they can help you manage
spread risk.
Yeah. So, okay. But what they were doing is they were using these LDIs not to manage risk, but to enhance returns. The way they would do that is they would buy bonds and they would lever them up with these derivatives. And so instead of let's say that you own a gilt, and the UK gilt is it's like the US Treasury in the UK. If you own a gilt and it's only yielding 1.5%, but you in your tables you need that to be 3 or 4.5%. Well, you can lever this position up 2, 3, 4 times. You lever it up 4 times. Well, now you're getting 6% return on an asset that's very stable. It doesn't move very much. It's not volatile. It's very it's very reliable.
Yeah.
Okay. Until, of course, you get a new finance minister who comes in and says, you know what? We're going to have a massive tax cut, biggest tax cut we've ever had. Just announces this policy, right, out of nowhere, and the bond market's first reaction was, well, wait, how are you going to pay for this? And he's like, well, we're not. And so immediately you go to, we're not going to change our spending habits. We're not going to have austerity to pay for the tax cut. We're not going to cut back on programs. All we're going to do is print more.
Right.
We're going to print money. We're going to print the UK sterling. We're going to print the pound. Right. And so what does the bond market do? They freak out. Why? Because of what we just talked about. That's a massive, it's a massive inflationary move. Right.
Yeah.
So it impacts the UK sterling, the pound sterling, and the creditworthiness.
Yeah.
And so the bonds dropped. Like everybody just started selling bonds. They're like, I don't want to own the UK gilts, right? And so they start selling. And then the pension funds who own these instruments, well, remember, when you own when you own a derivative, you're not putting 100% down on that derivative, because obviously if you're levered 4 times up, well, you're putting 25% down. Right? So you're levered to the point where you may get a margin call.
Yes.
So
this is amplifying their gains, but if it goes the other way, it's amplifying their losses.
Correct. Yeah. So when the gilt started to fall, it triggered margin calls. And so as you had a margin call, that automatically has the bank who is managing that derivative sell the underlying that collateral, which is what? It's a gilt.
Right.
So they're selling gilts while they're getting margin call on gilts.
Yeah.
And then it triggers another margin call for another pension fund. Their gilts are being sold, and it just snowballed over the course of just a couple of days. The pension funds went to the British, the Bank of England. Sorry, they went to the Bank of England and said, "Hey, look, we're going to go insolvent here this afternoon. You have to help us." And so what did the BOE do? They rushed in and started buying gilts to stabilize the market. Wow. And what is that? That's printing pound sterling and monetizing debt.
Right.
And doing exactly what they were going to do anyway.
Wow. What a saga. I'm glad you shared that with me, because I hadn't even looked into it at all.
But that's just one way, and people don't talk about that. But can you imagine if the UK pension funds failed? I mean, these are trillions and trillions of dollars. I mean, like that would have set off contagion across the world.
Right. And these are real people that depend on this for their livelihood past their earning years. Yeah.
They saved money. They put money into these pensions. You know, they were promised this is part of their compensation package all those years, and then it just disappears.
Right.
It's disappearing as we talk about it.
Right.
It's worth less now than it was when I first started talking about it just a few minutes ago.
Yeah.
You know? But in reality.
So that LDI, that I guess we'd call that an exotic strategy, right? Intended to shore up their returns to where they needed to be to meet these defined obligations.
Exactly.
So this is at root a symptom of fiat, though, right? That you're pushing these large capital pools further out along the risk curve, because of what exactly? The money's being debased, so the bond is kind of losing its credit worthiness over time. And this happens for all economic actors, but even at this level, so you push people further out along the risk curve, they start levering up.
Right.
That very push out further along the risk curve is going to increase volatility by the same dynamics you just described. So then when the volatility does hit and you're levered up,
you trigger crises. Yeah, exactly. And that's the problem. So, you know, people are worried about us going into a recession, and I am concerned that we're going to go into a recession here because of what we talked about. The Fed's going to keep the rates high. They're going to tackle inflation, but what they're doing is they know that they have. Powell has come out and said it multiple times. They have tools to shore up the economy. You know, well, what are those tools? It's QE. It's buying bonds. It's printing money. It's lowering interest rates, loosening liquidity, and so they know that they can reinvigorate the economy through money printing. But what we can't do is, if we have a spiral out of control inflation, you know, we go into hyperinflation, you can't control that. That's it. Once that starts, that's a wildfire that you can't stop. So we understand that, and that's exactly what they're doing.
So what are one of the telltale signs here, I think? You said, so we have a $500 billion gap that we're going to be...
Oh, that's... Okay, so go back
in the U.S.
Yeah.
There's a $500 billion gap. I think you said that Treasury would be selling bonds.
Yeah, but that's the rosy, that's the optimistic picture. The reality is that as we retire that debt, and we're going to have
the same principal gets more interest on it.
Exactly, and so they hadn't calculated that out fully yet. And so what we're seeing is that the Treasury just said they have to issue $932 billion of bonds this quarter.
Wow.
This quarter, right? So what's the problem? Well, tax revenues are down. Tax collections are down. Why? Because the stock market, stopped going straight up. And so the capital gains taxes are lower. Earnings for companies are lower. It's just, it kind of perpetuates itself, right? So that's one thing. And the other side is the debt. They're paying higher interest rate on all this debt that's maturing, retiring, and then they're putting new debt on.
Yeah.
And so we're going to have interest payments on the debt right now is up over $900 billion.
Right.
So it doesn't add up, and that's going to end up being in the trillions. So we're going to have, I'm estimating, we're going to have somewhere between $2 and $2.4 trillion of deficit this year.
Wow.
Yeah, that's just this year.
And so this is happening at the same time, and perhaps for the same reasons, that foreign demand for U.S. Treasuries is going down.
Yeah.
So I guess my question is, what percentage of that new Treasury issuance is the Fed going to have to buy?
Eventually 100.
Yeah. Just like Japan, right?
Yeah, exactly.
Yeah.
And that's what Japan is seeing, right? So, no, eventually what you do is you crowd out the balance sheets, right, Robert? There's only so many treasuries that Citibank or Citigroup or JP Morgan
Right.
or Allianz or Fidelity or State Street. There's only so much on of their balance sheet that they can own treasuries. Mm-hmm. And once that's all soaked up, then it's game over. Then the Fed has to come in and print and buy their own. They have to monetize them.
Right.
But I mean,
then you're printing the interest payments.
Correct.
Right. This is stage 1 of hyperinflation.
Correct.
This is as if, rough analogy, if you had 100,000, well, no, it's worse than that. What's the U.S. debt to GDP? 3x?
130%.
130%. So if you got 130K debt on 100K annual income, the interest expense, I'm doing a bad job with this analogy, but if you have to print money to pay just the interest to serve prior spending, which is captured in that debt, there's no real way to escape that short of some like miraculous innovation or huge explosion in tax revenue.
It's a debt spiral, right?
Yeah.
So you're essentially you're printing your way through it, but exactly what we were talking about at the beginning is eventually the balance sheets get crowded out.
Right.
There's a credit event. Maybe it's in the treasury market. Maybe a large investment bank blows up. Credit Suisse is on the edge.
Yeah.
That's going to produce contagion.
Yeah.
There's just no way that Credit Suisse blows up completely and everybody remains untouched. It's just not possible.
So the rock and a hard place is the printing of money is necessary to keep the scheme going.
Exactly.
The printing of money is undermining the credit worthiness of the bond issuer.
Right.
And so it's inescapable.
Yeah. You think that Credit Suisse can't blow up. They'll have to save it
Too big
somehow.
to fail.
Yeah. They'll have to save it. So,
and this is why all this, it's all anti-capitalistic to the core. And this is what bothers me when I hear people say we're in late stage capitalism. No, we're in late stage central banking. There's no such thing as too big to fail in capitalism, right? Everything can fail. That's the whole point.
In true capitalism.
Yes.
Which we don't have.
Correct.
Exactly.
Okay, let's talk about your informationist newsletter.
Yeah.
Very, very cool stuff. I like how you structure it. You're taking these admittedly complex esoteric ideas that we talk about and maybe a lot of people can't interpret, and you're distilling it into something understandable. So it's good work.
Thank you.
Can we talk about bail-ins, like what they are?
Yeah, that's exactly what we were just headed to, right? So a bail-in, but what happens if, let's say that Credit Suisse fails, okay? Well, so back after the great financial crisis, Cyprus they had massive bank problems and they were failing. And so what they did is the banks seized the depositors' deposits, their customer deposits, and they used those to pay off the creditors, right? So there were depositors, there were customers who lost 40, 50, 60, 70, 80% of their capital that was sitting in their bank account.
Wow.
So and it was awful. And actually I'd met somebody who it happened to, and it was devastating for her family, So, then flash forward, the EU was kind of like, that actually kind of worked, So I think of 2018, they passed a measure that said, yeah, if a bank fails, customer deposits can be seized. Okay. All right. So put that over there. Frank Dodd legislation here in the United States after the GFC, the Great Financial Crisis, same thing. If a bank fails, they can use customer deposits. Okay. So before everybody freaks out, there is a stopgap there, somewhat of a stopgap, where in the United States, your first $250,000 is protected under FDIC insurance, right? So if a bank fails, you're protected up to $250,000. Now, if you have $400,000 and the bank fails, say your retirement account is in this a small investment bank, and it fails, and your retirement blows up. All right, well, you're going to get $250,000 back. You're out $150,000. That's just reality. That's what they're telling you, assuming they have to use all customer deposits to pay off whatever debt they have, which is probably it's likely.
Yeah.
And in the EU, if I'm correct, it's 100,000 euros that are protected. But I encourage everybody to know exactly what it is, and what their bank is protecting them under, because some accounts are not protected. So you have to make sure it's FDIC insured. So, and it's an important thing. Yeah.
And you don't want to, I guess, don't ever keep more than that insurance threshold in a single account. Otherwise, you're taking an unnecessary risk, right?
That's correct.
Yeah.
That's right. So, and it, your stocks and bonds, all that's not protected.
Right.
It's just cash that's in a FDIC insured account.
Now, I've read that the FDIC is undercapitalized. So if they did have to pay out these insurance claims covering the first $250,000, would that involve money printing as well?
Go Burr. Yes.
Okay. So even the dollars you get back would be
they're just inflated dollars.
Diminished. Yeah. Okay. Wow.
Now I'd like to tell you about our sponsor, CrowdHealth. CrowdHealth is a Bitcoin-enabled alternative to legacy health insurance. Now let's face it, legacy health insurance is an absolute scam. Nobody can explain this better than the legendary comedian Chris Rock.
Insurance. You got to have some insurance. You got to. There's an insurance. They shouldn't even call it insurance. They should just call it in case shit. Like, I give a company some money in case shit happens. Now, if shit don't happen, shouldn't I get my money back?
So with CrowdHealth, instead of just paying premiums that you'll never see again, you can hold part of this pool of savings in dollars and in Bitcoin through CrowdHealth. And when you have a health event, you can draw against this pool of communal savings. So go to joincrowdhealth.com/breedlove to learn more or sign up. Now I'd like to tell you about our sponsor, Wasabi Wallet. Wasabi lets you use Bitcoin privately while still maintaining full control over your money. Specifically, Wasabi Wallet is an open source, non-custodial wallet with privacy built in by default. By using Wasabi, you're effectively putting the private back in private property. Wasabi Wallet is an easy-to-use privacy wallet that can support any amount of Bitcoin transactions. So go to wasabiwallet.io today to download this state-of-the-art wallet software. Now I'd like to tell you about our sponsor, Bitcoin Conference 2023. This 3-day event will be held May 18th through 20th in Miami Beach. This is going to be the biggest event of the year, as it always is. And the past 2 years in Miami have simply been amazing. Day 1's Industry Day. Days 2 and 3 are going to be open to general admission. And I'd say this is a great place to go and network with Bitcoiners or even look for a job. Just a really all-around great experience. There's a fantastic speaker lineup, including Michael Saylor, Zoltan Pozar, Lynn Alden, Alex Gladstein, many others. And last year, we did a 10 million sats giveaway for this event, and we're going to do it again this year. So to get discounted tickets and enter for a chance to win 10 million sats, Go to b.tc/conference and use code BREEDLOVE.
Now I'd like to tell you about our sponsor, Casa. Casa makes it simple to buy and secure your Bitcoin without wondering whether you're doing it right. Specifically, Casa provides a multi-key custody solution, which is by far the most secure way to custody your Bitcoin. Now, when I talk about Bitcoin being theft-proof money or inviolable private property, a multi-key custody model is exactly what I am talking about. Using multiple keys lets you maintain full control of your Bitcoin while also giving you redundancy in case you lose one of the keys. It's also the best way to secure your Bitcoin for inheritance planning purposes. So go to keys.casa, that's C-A-S-A, today to sign up and use discount code BREEDLOVE.
Okay, where are we, do you think, on that U.S. debt spiral path? Like, are we...
Well, we're in it. We're not getting out of it.
Yeah.
Even the Treasury admits it. You can go to the Treasury. They put out this report recently, and it was a report on the 2021 fiscal situation of the Treasury, right? And the subtitle was An Unsustainable Path.
Wow.
And it showed a chart of what they expect the debt to GDP to be. And it was like, Robert, it looked like a hockey stick. It just went like this from where we are today, and it went straight up. It's insane.
Yeah.
And this is the crazy part. They published this for everybody to see. They admit it. They know that this is a problem. It's not, they're not getting out of it. This is the path. This is where we're going. And I'm struggling to even understand why they would put this out there for everybody to see. And it's the only thing I can come to is arrogance, knowing that, well, we're the US dollar. Everybody needs us.
Right.
And so your question is, where are we in that? We're in it.
Yeah.
I don't know how long it takes. It could take decades.
Yeah.
We could have a credit event and it's over in months, but I don't think so. I think it's going to take decades. The US dollar and the US Treasury, they're so integral to the way the way money moves around the world and transactions occur that it's going to take a very long time to lose confidence. Anybody you talk to, well, your friends are probably pretty intelligent, but anybody you talk to, who even some intelligent people, they still think that the US dollar is backed by gold.
Yeah.
Which is incredible to me that people still believe that. They believe that Fort Knox and the Treasury has enough gold to give everybody gold for every single dollar that's out there. That's a big no.
Yeah.
Okay. It's not. We stopped that in 1971.
The Fort Knox hasn't been audited since. Fed's
Who knows?
Never.
All
Yeah.
right. And they also think that their deposits in the bank are actually sitting there. So if you walk into the bank and you said you have $70,000 in the bank, you walk in and say, I need my money. They're like, we don't have your money.
Right.
It's a loan to them.
That's right.
It is
I always
a loan to
encourage
them.
people to read that fine print. It's like it's a creditor-debtor relationship.
That's
It's not
right.
your money.
That's right. So it's an obligation. It becomes a debt on their book, but an asset as well.
Yeah.
So it's their asset. They owe it to you,
Right.
but
Yeah.
they can loan it out and put it somewhere else and use it for other purposes.
And they have a long history of rescinding those promises in times of crisis. So would not count on it. Do you think we follow a similar pattern where we have these liquidity crises, flight to Treasury in dollars, then central bank steps in to intervene, prints a shitload of dollars? So is it just?
But it's
That's going to get more extreme over time. These
yeah,
booms
it's
and
like
busts?
it's like that sine curve, right? Where all the peaks and valleys are exaggerated in each one, and the next time we print money, I mean, we printed $7 trillion this time,
right? And it was 700 billion in the great financial
I think it's
crisis.
going to be in the teens or maybe the 20s next time. You have to think about what we just talked about with the UK.
It's exponential.
It's exponential.
Yeah.
Japan, if you have you can't let these big banks fail. Like we're too integrated. The debt, we're so levered, the entire world. If you look at debt to GDP in the entire world, it's actually, Greg Foss likes to, he's done a calculation where it's closer to 3.5 or 4 to 1. I mean, that's
This is global debt to GDP.
yeah. This is like all debt. You know, not just sovereign debt, but
Right.
all debt. Like we are addicted to debt
Which
now.
makes no sense. How can you have
Right?
3.5 global debt to GDP?
You just keep printing. You know, we're just pushing off. We're borrowing from future productivity.
Yes.
It's like, okay, so debt in and of itself, it's not a bad thing, right? You know, if you want to go open a restaurant and you find that plate, you find the right lot, or you find the right storefront, well, you need capital to do this. So if you don't have enough capital in your bank, you've got to borrow some. You take out a loan, and you rent or buy the real estate. You get all your equipment, you get your ovens, you get your, you know, all your materials, and you hire your employees off that loan. And you're within months making revenue. You're starting to create revenue. You're creating GDP, right, off of that debt. Well, all you've done is pull forward the future productivity to today. So instead of having to make all that money to get the money to buy the restaurant or to, you know, open the restaurant, you can borrow it, open it up today, and it creates jobs, it creates productivity. It's great. You know, it actually is, it can be a good thing,
Right.
as long as it's used responsibly.
Commercial debt is useful.
Yeah,
Yeah.
it can be. And personal debt can be useful.
Right.
You know, it's useful for owning, you know, chalets,
Right.
in Jackson Hole.
Yeah.
It's no, it can be useful if you're able to borrow at very, very low rates on and enhance returns yourself responsibly. That can be a good thing.
So the problem is this unrestricted capacity of the U.S. government to borrow, right? There's no due process. There's no election. There's no democratic mechanism at all, right? It's just they decide how much money they need. They create a treasury, Fed prints it, or they sell it to the market,
Right.
and it's all the cost is externalized on everyone via inflation.
Exactly. But right now we're running up against a debt ceiling, right? Because with all it is the Congress decides how much the Treasury is allowed to spend, how much debt we're allowed to have, and every few, like, we have raised our debt limit, Robert, 22 times since 1997. We're going to raise it again, but right now it's just a showdown between the two political parties,
Right.
and you know, one is trying to get the other one to force them into austerity, and then they don't want to do that, so they refuse. And then so it's just like they're going back and forth. So what's happening? Well, we were talking about earlier is the you and I before the show, not to confuse your listeners, but the CDS swap spread on U.S. Treasury on the U.S. CDS swap spreads.
Can you
spiked.
define that just for people, the CDS?
Yeah, so the credit default swaps. People have seen. So anybody who's seen the movie The Big Short or read the book, which is better, Michael Lewis. The premise was they had all these bonds that were on the brink of failing, right? And they put them all together in a book of bonds, and they would sell that off, you know. And but then you could buy insurance against that book failing, right? And that insurance is called a credit default swap. Credit default swap, right? It's the same. It's just a contract,
risk, like you said earlier.
exactly. So, but here's the funny thing: it's like getting insurance on a failure, right? So, but credit default swaps don't require you to actually own the underlying asset. So, I could get insurance on your house, and then if your house burnt down, I could collect on that.
Right.
That's the way that credit default swaps work. So I don't even have to own your house, right? I could just get I can just get insurance on it.
Fair.
I mean, you think through about the implications of that, right?
Yeah.
But anyways, what we're seeing is that the credit default swaps you're usually quoting 5-year default swaps. That's the benchmark for these. But we're seeing the 1 year in the U.S. Sovereigns spiking right now.
Which
And-
indicates higher probability of default.
Correct. And now default can be a lot of things, and it doesn't have to be, you know, refusing to make payments, or inability to make payments, or like we were just talking about before, you know, changing the value of your currency,
Right.
right? So like Lebanon did,
Yeah.
right? Devaluing it. Those are all defaults.
Yeah.
You don't have to go bankrupt. You just have to miss a payment.
Yes.
All right. And it can be technical.
Yeah.
So what we're seeing here is that there's a showdown, and it's an increasing likelihood that we will miss a payment on our debt and what the Republicans are trying to force the Democrats to mess up.
Mm-hmm.
And so, but the Democrats are refusing to allow the Republicans to push them for austerity. And so we could very well default. The market is telling you that there's, there's like I think I wrote down numbers here for, so the market is basically telling you that there's a very high likelihood that the Treasury defaults, right? So that they miss a payment. And so the credit default swaps are going up in price. Well, and then you've got these people who are calling for us to avoid a default by issuing $1 trillion coin. You've heard this. Okay, so the U.S. Mint, this is so stupid. The U.S. Mint has rules about denominations of coins. So if they make coins in silver coins or gold coins, like they're like 5, 10, 15, 25, $50 denominations, and they kind of stop out, right? So, but there's a loophole. There's no limit on platinum.
Huh.
So you can mint a platinum coin for $1 million, $1 billion, why not $1 trillion? So what they're suggesting we do is we print $1 trillion coin. The Treasury tells the mint to mint it. Then they deposit at the Fed. And they borrow against that to meet their obligations, because they can't borrow. They can't issue any more bonds. They can't sell any more bonds. So they're just going to borrow against that $1 trillion coin. And if they run out, they'll mint another one.
Wow.
But until they raise the debt limit, which of course they're going to.
Yeah.
But can you imagine the rest of the world looking in on us as we print $1 trillion coin for this nonsense?
Right.
I mean, that's like literally an eyebrow hair away from Banana Republic.
Right.
Like, what are we doing? That we're even talking about this is just insanity. But that's where we're at.
Truly unreal. It feels like something out of that movie Idiocracy or something, like you just, and it, at least there's been an attempt to maybe obfuscate some of this printing money out of thin air up until this point, debt monetization, but this particular idea just seems so blatantly absurd.
Blatant. Yeah.
I wonder what effect that would have on the CDS, on the credit default swap spreads.
Well, so if they the $1 trillion coin, well, it would make them go down, right? Because it would just
in the short run, but then like the longer run,
eventually we would gravitate to a higher price for protection. I mean,
and you're compromising the integrity of the U.S.
absolutely
dollar as global reserve currency.
Absolutely.
Too. Yeah,
absolutely. It would be damaging.
What happens
without a doubt
if a nation defaults? And I'm sure this is dependent on which nation defaults, but maybe we just say like, what happens if a non-U.S. country defaults versus what happens if the U.S. defaults?
I mean, if a true default, meaning they decide they're going to write down their debt, pay the investors less for the principal that they have on it. Say it's called taking a haircut. That's one way that it would happen, or just stop making interest payments or make fewer interest payments. Something along those lines. They have a material change in the obligation, right? Well, that's a default. That's a real default. Okay, not a technical one where they chew you up in a couple of weeks once they get through the congressional nonsense. Okay, so what happens? Well, think about it. If you default on those bonds and then you pay those back, well, how are you going to issue more bonds? If you are, they're going to be a very high interest rate.
Right.
Who's going to buy those from you?
Yeah.
And trust that you're not going to do it again. You're not going to devalue their investment overnight. So it becomes a problem where you cannot borrow in your own currency anymore.
Right.
So, and we've seen that happen in a number of Latin American countries that they're borrowing on the U.S. dollar. They have to borrow in U.S. dollar denominated debt because they can't have their own currency denominated debt. Right. And so, so it's devastating for a country. Makes it very difficult to operate. You can't print money. You can't print you can't operate with the big boys at the table. And monetize your own debt in perpetuity.
So in that way, the U.S. will maybe never default because we would just hyperinflate the currency before we would default on U.S. dollar denominated debt.
Why would you default on your debt if you could print and monetize it? You wouldn't. If you're a sovereign fiat that has debt denominated in your own fiat, why would you you just print money and buy your own debt. It's what Japan is doing.
So do you think this culminates in the hyperinflation of the US dollar?
It's hard to say. I think that if you just think through it logically, there's no other way.
Right.
But is it going to happen tomorrow? No. It happened in 20 years, maybe 50 years, more likely 100 years, definitely.
Yeah. Wow.
100%.
Wow. And what should people be thinking about?
I wonder is there anything out there that you can think of? Is there anything that you can think of that is not inflationary? Yeah.
And hard to tax, easy to hide, easy to conceal, easy to move.
That's right.
Yeah.
So, and gold has a lot of those properties.
Yeah.
It does. But you can't, it's not easy to transport.
Mm-hmm.
It's confiscatable.
Right.
So yeah, we're laughing, but there's nothing that compares to Bitcoin. Nothing. It's not even close. Nothing compares to Bitcoin for holding your value and saving in it.
You think in that world, Bitcoin and gold operate, the world I'm referring to is post US dollar hyperinflation.
Mm-hmm.
Bitcoin and gold exist side by side? Like, clearly you're speculating here. No one's going to hold you to this. Like, what do you think that world looks like?
In the world that I envision, I think that gold will operate side by side for a little while, but eventually Bitcoin swallows it all.
Mm-hmm.
I just don't see the properties, and what'll happen is this is purely my opinion. What happens is there's just enough confidence in Bitcoin, and there's an ease of using it. The wallets are easy, the exchange, the Lightning Network, whatever. The transactions are easy, they're fast. I think once we get to the point where you have enough users of it, then gold just falls away. And I still think it has its value.
Sure.
And gold will be the thing that people hold in case something happens to Bitcoin. Right. So,
yeah, interesting. So it really is it's a confidence game, right? It's this confidence game right now that the Fed and US government are trying to maintain, right?
Yeah.
We need some inflation to externalize the debt, but not too much inflation to compromise future creditworthiness or expectations. And it's that psychological confidence game that we're lacking in Bitcoin right now, right? Like people still think they view it as this upstart speculative digital asset, not as a secure economic bedrock. But over time, as one confidence game fails, perhaps more confidence floats over to Bitcoin.
It's exactly what I believe.
Yeah,
I believe that will happen, and it's going to take time. It will take some time, but that's okay. We have time. I'm not expecting this to happen overnight. Long term confidence in this protocol. So that's the only way.
Yeah.
And that it gives us hope though.
Yeah.
It's exactly what you just said. I mean, like, what if we didn't have Bitcoin? Let's ask that question.
Oh, it's a dark world.
Like, think about that.
Yeah.
I mean, gold, you'd have people hoarding just gold.
Gold
failed.
failed.
And gold failed.
Yeah.
There's so much paper in gold. It's very difficult to trust that as a store of value. Right?
Yeah.
So, and central banks have incentive to keep that away from being a store of value.
Yeah.
They want you to keep your money in their currencies, not in something else.
Yes.
So,
yeah, absolutely. Yeah. Thank God for Bitcoin.
Thank God for Bitcoin.
James, man, I appreciate you doing this. Where can people find you on the internet?
Yeah, awesome. I had a great time. Always like talking to you, Robert.
Likewise.
So I'm on Twitter, just at James Lavish on Twitter. And yeah, if you're interested in the Informationist, there's a link to the Substack right there. It's a weekly publication, and just like you said, I take one complicated concept and break it down simply for everybody to get anybody, whether you're a doctor or a teacher or a fireman, you may or may not have any knowledge of finance because our schools just don't give it to us.
That's right.
So that's there. And then, yeah, if you want information about the Bitcoin Opportunity Fund, that's just the bitcoinopportunity.fund. And that link is also in my bio. So
Awesome.
I'll be there. All right, bud.
Appreciate it.
Thank you.